You heard what? That's what we're going to talk about today. Who are you listening to? There's all sorts of sources of news and misnews. It's really not news at all. And it impacts the emotional response you make in terms of portfolio decisions. Selective memory changes what you do and how you process the data that you're listening. And it has a potentially disastrous impact on the long term results of your portfolio strategy. My name is Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
So just before we started, Perry, you said, just remember what happened during COVID when it didn't matter where you turned on social media. It was just buy X and the market goes up. This is easy. What do you need an investment manager for? I mean, the market just goes up and you make money.
Everybody on Reddit was just like, hey, just log into Reddit every day, buy what everybody else is buying, whatever meme stock was at the top of the list. We're all going to get rich and we're going to run this market forever. How'd that work out, right? Not quite the way they thought. But when the sample time of you being an investor is less than 2 weeks, everything can look pretty good. In the short run, it's like, hey, this is the easiest money I've ever made, until all of a sudden it all went away. And that's what happens in investment markets. If you can make it very easily, you can lose it very easily. That's the way it works. And so it's so important not to let fear and greed drive your decision-making process. And that is why it's important to figure out who to listen to and who can you ignore and not even care what they have to say.
Well, that reminds me to say that we who have gray hair have been through bear markets before, and we've been through bull markets before. And I think back to the tech bubble, and it was very difficult as an advisor to stay ahead of what tech stocks were doing, because we're sitting there looking at risk and telling clients, this stuff makes no sense. As it turned out, that statement was very right. Companies that had .com behind their name and no business plan and no business assets, they were very risky, even though they were being traded on the market. And then you found out a year and a half, 2 years later, 3 years after the peak, that all of that fluff was gone. And so was a good portion of your account.
It was out. Yep.
When we go back to COVID, I mean, we had a different set of financially economic environment than we do today. As we've mentioned on some of our other podcasts, the tariff world and the change that's going on globally is not something anybody has ever lived through before. The last time this happened was 100 years ago, and none of the investors are that old to have been in the market 100 years ago.
Correct.
So we see the reaction in people jumping into Bitcoin. It's had some really strong rallies, but when you get really strong rallies, you also can get really strong unwinds. And those are unpleasant. I mean, they're very, very difficult to survive through. Most people end up with an emotional reaction. I'm losing money. This is never going to come to an end, and I'm going to bail out. And then now that I'm out, I'm never going to do that again. And we make another bad decision that we're not going to learn from our mistakes, change our process, or specifically our behavior, and go back in and rebuild that account, because eventually you're going to need more money than you have today.
And it's really hard. It's hard. I mean, that short-term pain is really painful. People that you're taking investment losses, but if you let that drive you into a panic selling, that's almost always immediately followed with regret. Boy, I never should have done that. And then you really start to second guess yourself. You get yourself into that situation where I know one thing, I can't trust me, and so I'm just going to sit still. And then you miss opportunities when they come, because you even stop looking. And that's why it's so important to have the rules in place that you're going to operate your portfolio by, and the discipline to apply them, whether it's comfortable or not. And that can keep you out of the situation where a short-term move, either up or down, can lead you to be in exactly the wrong place. But you've got to have those rules in place that will allow you to move around, to adapt to where the cash flows in the market are, and make those moves inside your portfolio in real time, when they're necessary, instead of just living with the regret of, wow, I got scared to death and I scared myself out of a great position. Or I got way too greedy and I got way overexposed in a position I never should have been in. It was way too risky. I didn't recognize it until too late. And that's what a rules-based portfolio can do for you. It can moderate that emotional response, which we all get. It doesn't matter how long you've done this. You're going to get an emotional gut response when things are going great and when things are going terrible. And if you make decisions at either side, either end of that spectrum, you can get yourself into big trouble.
And in the current environment, there are plenty of places that keep track of the emotional response of investors. And that general
True.
sentiment happens to be fear at the present time. As we watch markets coming down, we watch our portfolios shrinking, we see the headlines on the news at night, listening to gurus on various podcasts saying that the world's coming to an end. This is never going to turn out well. So
Right.
there's all sorts of reasons to be fearful about what's going on in the market. CNN has a daily update on a fear gauge. They have multiple factors that they use to calculate that. There's a site called Sentiment Trader, and I'm sure if you go digging around Fidelity or Schwab, you'll find other
They'll
fear
be in there.
indicators. Well, one of
Yep.
those fear indicators was analyzed by Barry Ritholtz and Ritholtz as an investment advisor, and they figured out that when fear reaches a level that it is now, 6 months out, the market's on average about 13% higher. So there's some point in time that's coming up here that's going to be an opportune time with reduced risk to put money back in the market. The question is, do you have a decision making process to get there? You need
Right.
to have a decision making process to get there. Buying and holding isn't always the best thing to do for your portfolio. Sometimes things take a long time to recover, one of which happens to have been the darling of investment in the last couple of years, which is
Yeah.
gold.
You
Gold
bet.
has been on a tear. It's outperformed the stock market by a big margin. But when we look at gold historically, people generally say, well, it's an inflation hedge. Well, if that's the case, let's go back to 1980 when gold was about $717 and we adjust it for inflation, then the $3,000 that we have today, $3,300 in gold, is actually
Right.
804 bucks. So we have gold, which
Wow.
after 45 years is now worth more than it was in 1980. Buy and hold has some disadvantages. That's the reason managers never actually buy and hold. They tell investors to buy and hold because they want investors to leave the money with the manager. Managers rotate when data and circumstances demand it. It's
Correct.
justifiable, rational decision based on rules, data, and process,
And that's
discipline
why
process.
we have gold in most of our portfolios where it's available and available choice right now because it's doing well right now. But it hasn't been in for the last 25 years nonstop because it has not been a good idea all that time. And that's the biggest advantage to trend following. It's like you can look at it, you can look at an asset and you're never saying, I'm going to add that to my portfolio and it's going to stay there forever. And you're also never saying, I'm selling that out and I'm never putting that back in my portfolio again. That's not the way financial markets work. Trends come and go, things cycle in and out of favor, and you need to be willing to put them in your portfolio when they're doing well, and then when they're not, take them out. You're going to still monitor them. You're going to still watch for when it's time to put them back in again. But you don't have to listen to the people. There's plenty of gold bugs out there that will tell you every day of every year is when you should be buying more gold, and it's just not true.
Well, one of the major mistakes that drive your emotional response is often listening too much to social media. We have a
Right.
what one of our professional resources recently quoted a tweet received from a close friend, He said, hearing everyone's thoughts 24/7 is the worst thing to happen to society since the mosquito. The mosquito is very small, but
Yeah.
but it's responsible for more deaths around the world than any other bug or virus.
Not to mention being highly annoying. So
That's
it's a
true.
terrible thing, and it's a terrible thing that you can get anyone's opinion on anything financial 24 hours a day, 7 days a week, whether you want to hear it or not. That's why it's important. You've got to filter that stuff out. You can't just sit around listening to financial press all the time, or financial blogs all the time, or investors all the time. You've got to unplug from that stuff. Distill down your information sources to some reasonable people that you can trust with at least giving you an honest view of what's going on. No one's going to tell you what's coming up. No one knows. I guarantee you we don't, and no one else does. You can line up as many PhDs as you want. They don't know any more about what's coming up than you do. No one can tell the future, and don't start believing they can. So you've got to filter the amount and where you get all that information from.
Well, you made a reference to PhDs. The Federal Reserve has something like 400 economists who are PhDs on their
Yeah,
staff, and they
right,
continually have made mistakes, not just with COVID and afterwards, but in
right.
prior years, even before Mr. Powell became chairman.
Was there,
It
sure,
was there. We had the Fed making mistakes when Janet Yellen was chair at the Fed, and it
sure.
takes a long time for those mistakes to work their way through the economy. So it's more important that you understand what is it you are trying to do. How are you going to make the decisions? Now, what we're talking about is not rocket science.
Right.
Neither one of us are rocket scientists. We
Not even close. Yeah.
not close,
No.
but learning what to do in financial markets is something that requires some discipline. You have to figure out what your rules, and there's lots of ways to learn rules, part of which is making mistakes. But a successful portfolio manager, whether it's you or you have it hired out for you, is recognizing the mistake has been made and getting out of it quickly instead of rationalizing all the reasons why you bought it. Because your
Right.
reasons may have made sense at the time, and you get some factor outside of your control that suddenly collapses the whole reasoning process you went through. That happened recently with healthcare. In the recent market, we've had some really bad news come out of some healthcare companies, and the healthcare sector, which is normally a safe place to be in a slowing economy, just
Yep.
simply had an exaggerated collapse until people figure out just how perverse is this through the industry. How widespread is it through other companies? Are they all having the same kind of problem with the product, with the planned introduction of various products?
Right.
It, you can't control that. And when it happens, the question is, are you going to sit around and just kind of lick your wounds and feel sorry for yourself? Or are you going to be proactive and make a decision to stop the losses? Something else is going on. There is an adage in the market. There's always something going up. Presently, it's gold.
There you go.
Silver's been doing okay, not quite as well as
Not as
gold,
good. Yep.
and it may do catch up. We don't know that. Bitcoin looked like it was going to be an alternative to the market, but it's had massive drawdowns that have been very, very painful. At the time we're recording this, it's had a couple of days of recovery, and they're big days.
Sure.
But are you going to hold through all the bad news drawdowns that come with an asset that has nothing behind it but a data entry?
That's it.
We don't know that. Nobody knows. Theoretically, there'll be a day when it has more universal acceptance and application. But right now, it's a speculative asset.
100%. And again, this is about who do you listen to in times like this when there's a lot of volatility out there. It's very important not to let someone get in your head and push you around one way or the other way mentally, saying, "Hey, you've got to that this is the bottom. It's time to dump in all your cash, or you're way too late, but it's still time to sell everything you own. Don't listen to them. Follow your rules, follow the metrics you look at, and don't let the talking heads convince you one way or the other. They don't know any better than you do.
That's why we started this and labeled this. You heard what? Well,
Yep.
we should also say, and from where? Social media is not a good place to get that information. And as we know in this current environment, Wall Street isn't either. You really
Right.
need your own data set, your own process, your own discipline to work your way through here. And if you
Yeah.
need help with that, that's what our business is all about. You can give us a call. The contact information is coming right up as we wrap this up. Thanks for being with us. Stay tuned, subscribe. You'll be updated on our next post. Have a great day.